What is up, everybody? Welcome back to Bitcoin and Markets and Rogue Macro. This is another dual stream. So if you guys are watching on the Bitcoin and it's the BTC Market Update channel, check out the Rogue Macro channel as well. I'm going to be putting more macro content over there and more Bitcoin content on the Bitcoin and Markets. But in this intervening time, I'm going to be cross-posting. So check out both those channels. I'm also going live on Telegram. That's my community over there. We hang out all day, talk about macro Bitcoin topics, price, gold. Gold has been dipping today, but we're going to take a look at that now as well too. This is the Bitcoin chart. I had it like this a little bit earlier today, touching this bottom. But then somebody on the Telegram said, dude, you don't have that bottom line steep enough because it touches this bottom here and then goes like that. So we'll see. Whatever the case is, it is a widening megaphone pattern, more volatility. I hope we break out to the upside. It is a majority bullish sign. Sometimes these will break bearish, but that's probably 20%, 80% of the time it breaks bullish out of these megaphone patterns, especially if you come into it from the bottom, you break out through the top. But yeah, increasing volatility, as you can see, which is really good for Bitcoin because we've been so sideways for so long, and it gets a little bit boring, especially for us old-time Bitcoiners, us old men out there. It is like this volatility. It doesn't bother, the volatility of it doesn't bother me whatsoever. It's just the fact that, look, there's the Bitcoin treasury companies have added 8%. They've gone up 8% in the last 30 days, the number of Bitcoins they've held. That's a huge, significant amount. It's thousands and thousands of Bitcoins. And ETFs are adding Bitcoin. All these people are adding Bitcoin. It's just the cognitive dissonance between all of this buying, institutional buying, and the price dipping. But I do think that there is some market makers out there that are trying to, grab as much liquidity as they can before they let go and let it rise. I think this can quickly go to 150, if not 200. I mean, it could really go in just a few weeks' time, maybe 2-3 weeks. It could go past 150. That's how much I feel there is pent up demand, or the spring is so tight. That's how Sam Callahan talked about it this morning on Spaces. So I also do Spaces for BitcoinTreasuries.net, and I have guests on. And this morning I had Sam Callahan on and Joe Consorti, and he was talking about this market is just a spring. It's just getting tighter and tighter and tighter, and when it actually goes, it's going to go pretty fast. Now, he's an old school Bitcoiner. I'm an old school Bitcoiner, and I think that we are seeing and feeling the same things out there in the charts. Okay, so that's Bitcoin. Let's talk about gold. So gold is having a sell-off today, a little bit of a bounce here towards the end of the day, but you can see that it could have been a bearish engulfing candle, which would have been like this one back there, but it would have been pretty nasty one at the very top. The one chart that I'm looking at a lot is the monthly gold because of this, because of the RSI. The RSI is at 92. That's the highest since 1973, so 52 years ago. And that was during the Great Inflation. A lot of people will be inflationistas and they'll think we're in high inflation times right now. We are not in high inflation times. That was high inflation, 1970s. But there was high amount of growth. Now it's more of a stagflation now. It's a very low, I would say, stagflation. The economy is stagnating, but there is slight higher levels of quote unquote inflation, price rises. So nothing that would make gold run like this. It is so oversold. There's got to be something. I was watching Nick Bhatia, his take from yesterday. If you go watch Layered Bitcoin, the channel, he was talking about this looks like a short squeeze. Someone's blowing up. There's also been some problems within the banking system. Smaller regional banks are having some problems. Their credit, credit spreads are blowing out a little bit. Nick Bhatia was talking about that as well. But still nothing acute that would necessitate this gold moving like this. So somebody is either blowing up some large outfit for some reason. Nick said he didn't know. I don't know why this is happening, but we do see this, and it is extremely extended. Of course, in these types of moves, it could go up for another week and go up another 20%. That's how these blow-off tops work. But we're getting very close to the top. A 92 on the monthly is not sustainable, people. Okay? You can correct a market in price or time. So you can dip really hard. If you dip really hard, drop 50%, you're going to cool off the market really fast. And then you can continue going higher. But if you don't do that, which I don't think is going to be the case for gold, it's going to correct in time. And that's one reason why earlier this year, if we go back to, let's go to the weekly. So if we go back to here in April, I was a gold bug before I got to Bitcoin. And I sold some of my gold here at this top back in April. And it just kept going sideways. I thought, okay, it's going to consolidate for the rest of the year because it was overheated back here. How overheated that is on the weekly. Let's see where it was on the monthly in April. I mean, it was very overheated already on the monthly as well at 85. So I'm like, okay, I'm going to sell a little gold. I didn't do all of it, but I sold, probably about 10, 20% of my gold back here. And then on this run up over 4,000, I sold another 10, 20% because it's really getting extended, like I was saying. Okay. Weekly, monthly, daily, everything's blowing out heat. And I think that it's ready to pop with a blow off top. Okay. So that's gold. Let's take a look at the dollar. Talked about this Adam and Eve pattern. Adam and Eve is a sharp bottom followed by a rounded bottom. You can also have an Eve and Adam. But this Adam and Eve, that's a very classic pattern for a bottoming, kind of like a double bottom as well here too. And things don't triple bottom or triple top usually. They'll double bottom or double top. And so if this does start falling back down here, you can extend this round bottom out. But if it breaks to a new low, then that's invalidates this. But for right now, I am pretty confident that this is a bottom for the dollar, and the dollar is going to go higher. But not a lot of action there. US 10-year on a weekly, that was weekly. Daily had a bounce off the bottom, got all the way down to 3.94%. And now it's rallying back over 4%. I don't think this is the bottom for yields. I think it's going to continue going down. We're only about 2 weeks away from the next Fed rate cut. Now, if you guys go back and if you remember my last reaction to the Fed back in September, I was reacting. I said, oh my gosh, I think they're going to have to do an emergency cut. Just something in my mind was like, they are behind and they're unwilling to see that they're behind and something's going to blow up. I just had that inclination when I was watching him at the press conference. And I said that on the live stream. I said, they might have to have an emergency cut. If things keep going, if we still get these credit spreads blowing out, get these the repo market malfunctions that we're starting to see, next week we could see some sort of move by the Fed early. I think it's pretty much 100% that they cut 25. They might even cut 50. But yeah, things are going to have to start moving here with the Federal Reserve because there is things going on in the market. Now, what are those things? I think it could have something to do with the government shutdown. It could have something to do with cutting, like different NGOs getting funded, different money laundering schemes that have been blown up. Like that can have ripple effects down the line. A good example is this First Brand. I think that's the name of it. First Brand. It was a auto lending company, and they concentrated on illegal immigrants here in the United States. So what happens when you deport all the illegal immigrants and you start going after them? these things blow up. And this was a billion, like I don't know, $4, $5, $6 billion outfit that just blew up overnight. And that can have ripple effects. So some of these things, we're going through this motion of changing the economy, right? Where it is a process of creative destruction. And I think creative destruction is happening right now. But that can snowball, right? Because everybody is linked. Everybody is linked to everyone else's risk through the shadow banking system, through the repo markets. And yes, we're going to have some creative destruction. Maybe that's from the different policies going on, but it can snowball. Now, I think, having said that, this is somewhat of a unique situation where there's a possibility that they can resolve it. This whole talk about back during COVID, and we had these, the high CPI, and they were hiking rates like crazy, and people were talking about hard landing or soft landing. And then, of course, there's a third option, that's no landing. And people are like, oh, that's never going to happen. That never works out. It's always a hard landing. It kind of worked out. There hasn't really been an extreme blow up in the markets yet. And it's possible that the Fed is able to tightrope walk this to some sort of soft landing as we remake the economy, as the economy gets remade. And we are actually remaking the economy right now with all this onshoring. I mean, there's trillions, something like $6-7 trillion worth of investment that has come into the United States to build up the manufacturing again. And so it's going to take several years, but it's going to happen. All right, so that's that. Let's take a look at oil. I did tweet about oil this morning. Man, everybody seems to be all of a sudden bearish on oil. I've been bearish on oil for years. I called the top to pretty much the day, maybe the week. I was interviewing Luke Gromen at the time. Famous, maybe Luke Gromen. And it was right here at the top within a couple days. And I said, what if we're at a top right now? And he's like, oh, no, we're nowhere near top. This could go 200. And then what happened? It was the top and it went down. And I've been talking about this the whole time. This is what's going to happen. We're going to oscillate down and fall out and go lower. We're in the middle of an oil glut, people. Oil glut. And we're also, not only are we supply-wise in a glut, we are demand-wise slowing down. Like, what do you think is going to happen to the global economy when you have tariff wars? Is the economy going to grow? No. The marginal demand unit is getting weaker in a global economy for oil. At the same time, OPEC is pumping up their production. The U.S. is hitting all-time high production month after month, week after week. And so, this is obvious what's going to happen with oil. It's going to go lower. And then you have some, cultural things mixed in there with EVs becoming more popular and all of that stuff. I think that's the margin of the margin. That's not the whole story, but that is a factor as well. And working from home. I mean, there's a sizable percentage of people that are working from home now after COVID. I don't know exactly what that is. I would have to look that up, but I would say it's maybe around 25%, maybe a little lower than that. But that's another margin of the margin where you're not having to spend gas on sitting in traffic and driving to and from work. So the commutes are lower. And so all of these things add together to put downward pressure on the price of oil. And I think that's going to continue. All right, S&P 500. After this, guys, we're going to react to a George Gammon clip real quick. It's a short one, so hopefully I can get that done quickly, and we can be off on our weekend. So S&P 500, this is the weekly. Let's go to the daily. Up on the day. Real quick, TA. This isn't like super bullish, but it's not super bearish either. We've done that many times before where we come down and then just go right back up. So it's not super, super bearish, But one could say this does look a little bit like a flag and it could break down. I'm not too worried about this at all. I don't think we're at this. So talk to me in first quarter. Talk to me again in the first quarter. I think the story, as Nick Bhatia was saying when I interviewed him this week, the story is just slow climb, slow, boring climb. It could be a slow, boring climb for bond prices and a slow, boring sell-off for bond yields, or it wouldn't be a sell-off, but downward for bond yields. Bitcoin price, same thing, slow, boring up. But I'm not seeing anything structurally harming the U.S. stock market right now for the rest of the year at least. So talk to me in Q1 of next year. Okay, that's the Bitcoin price. All right, let me check comments. Hope I'm live on all of the platforms because I'm showing the chat cannot connect for some reason with my back end. So guys, if on YouTube and Kick, I'm on Kick now too. You guys, I cannot see your comments. Sorry. I wonder if Dex Invictus is back with us. But all right. So let me check Telegram real quick. David says, I work remote. Massive gas and time savings. Could never go back to normie office life. Yeah, exactly. Exactly. Same with my wife. My wife works from home now too. And I mean, I think she has to go in the office once a week, but that's just to see the patients. And then the rest of the time she can work at home. So yeah. Okay. Let's go ahead. Uncle Swan, what are you saying here? Yeah. Sorry, I'm just reading the comments here. Do I have a bad link or something? Uncle Swan? Well, let me know. Okay, let's go to this one. This is George Gammon, of course, Rebel Capitalist. This is a live stream of his. Want to do the debasement trade? Don't just buy gold and Bitcoin. I think this is the one you guys requested me to respond to, so that's why I'm doing this. So let's go ahead and make sure everything is sharing out properly. Stop screen share. Make sure the screen share is sharing audio. And guys, I'm going to give you a better view here. All right.
Hello, fellow Rebel Capitals. Hope you're well. So everybody has been talking about debasement trade. Gold is over 4,000. Bitcoin is almost at all-time highs. Silver exploded over $50, and it had to be because of the debasement trade. Well, I'm going to tell you right here in this video, number one, might not necessarily be true. I'm going to give you a whole plot twist right here on the whole debasement argument or narrative. And then I'm going to show you what I'm doing in my own portfolio to have maybe better odds of playing the debasement narrative, we'll say. And I got this strategy from some of the pros I know that have been doing this for over 40 years. So you're going to want to sit down, buckle up, pour yourself that stiff drink.
All right. So debasement trade, that is the trade that I've been on since the year 2000, basically. When I've been started as gold bug and then found Bitcoin. This is nothing new. And people, I don't really think anything's changed other than people talking about it, people using the term debasement trade. I mean, it's simple. You buy hard assets. That's what you should have been doing all along.
because we're going to get into it right. What is the argument for this debasement trade and gold being over 4,000 and Bitcoin being at almost all-time highs? Well, you guys know. Let's look at this chart right here, M2 money supply. So most people define currency debasement.
Oh, man. Is he really going here?
By a loss of purchasing power in, let's just say, the dollar, because you're creating more and more and more of those dollars. And what we have to realize as investors is it's all about the rate of change, especially in a debt-based monetary system. You guys know that from watching my videos. So we look at this chart and we can see.
Hey, at least he said that, debt-based monetary system. I mean, one thing that I like to do is strip away all the complexity. So if you want to compare prices, well, first off, the reason why they compare prices with CPI and they call that inflation is because they can't count the money. They know they can't count the money. They've tried to count the money. It's in the shadow banking system. It's quality, not quantity. Okay. Next, if you're trying to compare prices with complex goods, so import a completed electronic good or import something that a retail product, there's so much that goes into that. So you could have a war in the Middle East kick off. The price of oil spikes $20 a barrel. That cost gets filtered down eventually. I mean, not immediately, because there's things like hedging and futures and different stuff that keep that shock from happening instantly. But a month or 2, 3 down the line, you will start getting prices going up because energy is more expensive. But that isn't a inflationary process. That is a war in the Middle East process. So there's many reasons why prices can go up and down, especially when you're looking at complex goods. So I like to look at commodities. And yes, there are things about commodities as well. Energy prices are to take commodities out of the ground. That is an energy intensive process. But there's a lot fewer moving parts when you talk about the price of oil or you talk about the price of corn. Okay. There's just a lot fewer moving parts. And when you look at commodities right now, they are not inflationary. We just looked at oil. We can look at some other commodities. Let's go ahead and do that real quick. So I have a list of agricultural commodities. We'll go to the weekly and zoom out a little bit. So this is corn. You can see corn is not near all-time highs. It's like 50% down from all-time highs. Soybeans, same. Wheat, same. Now this one is a little different. Oh no, that's cotton. I saw the C. I thought it was cattle. Cotton, same. Rice, same. Rice is falling through the floor right now. Now, when we get to livestock, it's going to be a little different. Cattle, for one, is really high. But this, again, prices can move for a lot of different reasons. We started this year with the lowest herd numbers in the United States since 1952. Okay. This is a supply issue. This is not a inflation issue for cattle right now. Because if it was an inflation issue for cattle, we would see it in corn. We would see it in soybeans. We would see it in wheat, right? Because that is, everything would be going up. Here we have cattle again. These are feeder cattle versus live cattle. And hogs, they're somewhat higher, but you see we gap down today. It's not particularly inflationary here. I mean, we could even draw a line like this, and we dropped below that today. So, we're not seeing any inflation there. How about we go to some other things like copper? I mean, it's slightly high, but it's not blowing out or anything. It's around $5. It was around $5 back here in March of 2022. There's not a lot of inflation here in the copper. Plus, there's stockpiling of copper. So during COVID, famously, China stockpiled a lot of copper, and they can unwind that if they want to. They can add to their stockpile. So this is one of these commodities that people can kind of stockpile. We can look at gasoline, not just oil, and it's down here at 178, looking very bearish on the drop down here. What else? Lithium. That doesn't look too inflationary to me for lithium. That's a rare earth that we're talking about from China. So if it spiked back here, but it's way down from where it was in 2022. It was 86 or 85 back in 2022, and now it's at 9. That's not inflationary. How about aluminum? Aluminium. I mean, you could say that it's kind of going up right here, but it's down from where it was in 22. We've been at roughly these levels for at least 7-8 years for aluminum. How about lumber? Same story. Pretty much level across the board. Natural gas. This is the Dutch, the European natural gas. It is down, way down from 22. And if you zoom back out, it's about the same level it was as it was back in 2018. And Henry Hub, U.S. natural gas as well, not really inflationary. So there you go, guys. That's the commodities that you can look at. I'm sure there's more like coal that I'm not looking at and things of that nature. Maybe I should add those. But overall, you can see commodities are not really that inflationary. If we look at a commodity index, same thing. Let me make sure it's on regular scale. Same thing. The commodity index is like, I would say it's more bearish here than it is bullish for prices. So getting back to George Gammon, people are talking about inflation. There's not really any inflation in the core. Now, what can be the final prices, like the retail prices? Yeah, you're going to maybe see some different price movements because it's so complex and dynamic, especially when you start talking about tariffs and all this stuff. Elasticity of import demand. I mean, that type of stuff is serious and has big swings on the price. And it doesn't get captured in just looking at prices. So there you go.
That, my goodness gracious, from 1960 to even the middle of the 70s, it's pretty flat. And then in the 1970s, it really starts to ramp up. Get a little bit of a flattening there, interestingly enough, in the 1990s. And then it really starts going parabolic. And then when we get to QE 1, 2, 3, look at this chart. Look at the trend, although it's straight, but look at how much more of an angle. Look at how much more extreme it is and going higher and higher and higher. And then we get to the cerveza sickness. It goes completely parabolic, straight up. And then we go, and then you guys know what happened in 2021. It goes up by, 25% within the matter of a year or two. And then it goes down slightly. But now we're right back to where we were. And let's say the QE 1, 2, 3 era, where money supply is growing at just as rapid a rate.
M2 is not money supply.
If you look at this chart. But you'll notice this chart is just simply a total number of dollars. This doesn't tell you the rate of change. And why is the critically important? Well, let me put it to you this way. Would you rather buy a stock for...
Wee Willie, you say, how come I'm not talking about the Bitcoin Core V30 debate? Because, I mean, I was hardcore in the technicals back during the scaling conflict. Hardcore about that. But now it's just not... Bitcoin is too established. I don't think that MicroStrategy and the U.S. government, are going to let something happen to it. IBIT, BlackRock, those guys, they're not going to let something happen to it. We're too far along in the process, and it's open source. We can read the code, and as far as I understand the conflict, there's very smart guys on both sides, and so I would say more smart guys on the Core 30 side, and it just doesn't float my boat. Yeah, and it doesn't affect the price, as Barron says. Good call, Green. Gabriel, because it's highly complex and nuanced, and no, probably won't affect price. Yep. All right, let's keep going.
For $100 that is growing, or the company or the share price is increasing at 20% per year? Or would you rather buy a share of XYZ company that's trading at $1,000 per, let's say $1,000 a share, where the stock price is going up by 1% per year? Which would you rather have? The cheaper stock going up at 20% per year, or the more expensive stock going up at 1% per year? This is why you want to look at the rate of change. And you could take that to an extreme, that example, where even that 1% increase would be much, much more than the in terms of nominal dollars, than the percentage increase, or the nominal dollars you got from the percentage increase of the $100 share going up by 20%. You guys get my point. You're intelligent people. It's all about the rate of change. So if it's all about the rate of change, if we really want to know what's happening with currency debasement, we can't look at this chart. We've got to look at a log chart, because that's going to tell us the percentage change from year to year. So now let's switch it up. And I've got this chart already set up because I did this in a whiteboard video today. And it tells not just a different story.
I mean, if you want to look at percent change, go up to this edit graph button and go to percent change year over year. I mean, percent change since last year. It'll show you the annual rate of change year over year.
It tells the complete opposite story, doesn't it? Look at the rate of change from 1960. You can tell just by the slope of the trend line here. From 1960 to, just call it the early 1980s.
I'm going to do that. Fred M2. Let's get into it, guys. Let's pull it up. We're cooking here. Come on, internet. The heck? Why are you not loading? Okay, I will let that load and then we'll see what happens. Anyway, let's continue.
80s. Now I want that with the trend line from, call it 1995 all the way to 2019. From 95 to 2019, it's a much lower slope. The trend line is lower, meaning the rate of change for money supply growth was a lot less from 1995 to 2019 than it was from 1960 to 1980. And you say, well, George, that's because of the 1970s. Now look at the rate of change in the 1960s. It wasn't that much different in the 1970s. And oh, by the way, going into the 1980s, look at the rate of change versus the 1970s. Almost identical, which begs the question, what did Paul Volcker do? And the answer is not much, but that's a topic for a completely separate video. So then we go over to the cerveza sickness and look at the rate of change here. It definitely goes up, But then we peak out around, call it 2021, 2022. It goes down. Now it has been going up over the last couple of years, but look at this slope. In fact, what I'm going to do is I'm going to zoom in and let's look at 2000. And now you can really see, we know this slope is less than it was in, let's just say, the 1980s. And now we're looking at this increase, and it looks to me like it's even lower than it was in the 2000s or the 2010s as far as the rate of change. So the argument here for the debasement trade is the or the growth in the money supply that we're seeing. The debasement of the currency is totally unprecedented. Totally and completely unprecedented. Because what they do is they show you this chart. They'll show you this chart. And they'll point to this right here. When this is, it's either being a little ignorant or it's being intellectually dishonest. If they're really being honest about it, they'd show you this chart, which tells you the complete opposite story. Now, I know a lot of you right about now are saying, well, George, you can't use this as an example because when you include...
This makes me think, I've been saying we have a lot of room left. Like a lot of people say, oh, it's 30 trillion in government debt or 37 trillion, whatever we're at now. Look at M2. They've added so much to M2. I'm like, dude, we have so much further we can go. so much further. M2, again, what I'll say about this is M2 is not money supply. It might be the best thing we can measure, but it's not money supply. The supply of money is esoteric, and it's in the shadow banking system. It's cash and cash equivalents. It's circulation. It's liquidity. If liquidity goes down because people perceive a higher risk, okay? Liquidity goes down because people perceive a higher risk, and so they're not circulating as well. It's not as liquid. That will effectively shrink the money supply. Okay, so it's a qualitative thing. It's not a quantitative thing. So M2, rate of change of M2 really doesn't matter either. You could probably pick out some useful information like I don't even know what you would say. Maybe like the rate that shadow money is being drawn into the light is slowing or something like that. I don't know. I would have to think about what you can exactly get from M2, but it's pretty much an artifact. It's an artifact of the way the monetary system works. Eventually that money will end up in M2, but that's not what really matters. The money supply that really matters is the circulating liquid money supply in the shadow banks, not the money that I have in my checking account. I hope that makes sense to everybody. That Fred never loaded. Let me try again. Now Google loads, but Fred seems to be down for some reason. It will not load, so.
This massive spike right here, the amount of currency units that were created, let's just say the percentage total, was much greater, unprecedented from 2020 to today's date than it was at any other time in U.S. history. And this is why the gold price is going over 4,000. This is why silver is trading over $50. This is why Bitcoin is trading, let's just say, near all-time highs. Now, I'm going to address that right now. Before we do, I want to point out that the rate of change since this money supply growth started to increase is a lot lower than it was before. We pointed that out. Because the argument, the pushback I'm going to get there is, well, yeah, sure, it's been like this, but in the future, it's going to be a lot higher, very similar to this. Maybe, maybe not. Right now, we don't see that. But now let's go back to the argument that the aggregate total is so extreme. This is really what the gold price and the debasement the gold price is sniffing out. Okay, so we're going to go over to long-term trends. So let's
look at all those tabs, man. Man after my own heart there. Look at those tabs.
Let's look at the aggregate total increase in money supply since 2000, just before the cerveza sickness. So we've got February 2020 to August, so almost today's date, August 2025. And you can see it increased, using M2 as a proxy, by 3%. 43%. So most people out there would say, George, I told you, 40%. That's an astronomical number. That is even though the trend has been, let's say, rather benign, relatively speaking, over the last 2 or 3 years. It was front-loaded to this massive degree that you have all this money sloshing around the system and just trying to find a home. And that's what's going straight into gold and silver. And it's going to do the because the Fed's going to have to do yield curve control or insert excuse here. And therefore, we're going to have even more debasement than we had before. And even if it doesn't, who cares? Because we had so much debasement at the beginning, 2021 into 2022, that it more than takes care of maybe the lack of debasement we've had. All right, let's go ahead and put this to the test. So what I want to do is I want to look at a time frame when we had massive disinflation. Because the flip side, or the maybe it's not the flip side, that's not the right way to say it, but the same argument that we were going to have currency debasement is effectively saying that we're going to have increased rates of inflation, right? Same thing. So now let's go back to 1980 to 1985, because you guys know very well that we had massive disinflation. Now prices were still going up, but they were going up to a much lower degree in 1985 than in 1980. And let's compare that to just what we've seen over the past 5 years, where we've had relatively high rates of inflation for the United States. So let's go back to 1980. And of course, what you would expect to see is that we had much lower rates of money supply growth. Higher, 60%. When, just as a reminder, 2020 to 2025, it was 40%. Now let's do some other comparisons. Let's go to 2000 to 2005, right around 40%. Let's go to 2010 to 2015, right around 40%. So you see what we have had, although I don't like it, I'm not a proponent of expanding the money supply by 40%, especially if it involves reserve. But it's not even close. Not even close. In fact,
yeah, and I wrote a post a few months back about the classical gold standard too. Under the classical gold standard, monetary gold increased by about 3.5% every year. So it was inflation as well. And my point of that post was to say that this is the experiment of a Bitcoin standard. We've never done it before. And, gold increased by 3.5%. It had a 3.5% inflation rate. But we've never done anything like Bitcoin. So Bitcoin is a brand new, unprecedented experiment. I also used that post to say that inflation isn't always a bad thing. And yes, I know it's a hidden tax and we don't like it. We like sound money. We like pristine price signals. I agree. That is the most efficient thing. But as George is pointing out here, high levels of this sort of M2 creation, which I would say in 1980, M2 was more legit. Now it's almost not legit at all. But high rates of money creation don't necessarily lead to inflation or price increases. And it can lead to greater living standards and all that stuff. But what I would say is that there has to come in some amount of growth. Okay, you have to have growth. So comparing M2 growth with CPI and GDP, like this chart is doing here. So in 1980, we had a lot of growth. In the 80s, we had a ton of growth in the United States, and the economy demanded a lot of more money, right? A lot more credit. And so the economy, the banking system facilitated that. Now we need a lot more credit, not for growth, but to pay off debt. So it's not a growth story anymore. That's the problem. But yeah, all inflation is not necessarily a bad thing all the time. And you guys might roast me, but hey, that's the way it is. If it leads to growth, you're going to inflate. The economy is going to inflate. It's not like there's even a choice. I mean, there is a choice. Maybe going to Bitcoin is almost the only choice, because if you go to gold inflates at 3.5% a year. Even during a gold standard, it inflated more during a gold standard than not on a gold standard. They dug more gold out of the ground. So if you can inflate, you will inflate. And this is a market-driven process. The market is demanding more money. And so it's provided with that money. Anyway, it's just some thoughts.
At a time frame when gold price was plummeting, that was back 1980 to 1985, and we had disinflation, the aggregate total money supply growth was much higher than in percentage terms than it was from 2020 to 2025. So it's very difficult to say definitively that the reason the gold price is at 4,000, and you guys know I'm very, very bullish on gold, but mechanically, it's not the debasement trade. Now, narrative speaking, yes, it's absolutely. This is the narrative, and this is why I think retail is going to come on board and probably push the price even higher over the next 3 months, over the next 6 months. But just because it's the narrative doesn't necessarily mean that it's reality. But at the end of the day, reality doesn't even matter, because it doesn't matter what this chart says. It doesn't matter what George Gammon thinks. It doesn't matter what you think. It only matters what the market thinks. Now, I know a lot of you right about now are saying to yourself, okay, George, well, this just proves.
Well, the market doesn't think. And I know he didn't really mean that, but the market doesn't think. Okay. The market is it's information. It's just relaying information to actors, right? So it's just information. It's not thinking at all. The market doesn't want to do anything. The market just does. It is. And I do think that's kind of an important point, because a lot of people will, you talk about fighting the market, or that the Fed can control the market, or all these other ideas that kind of anthropomorphize. It's just, the market is another word for nature. Okay. It just is. And it's just information for individual actors. And are we individuals? That's my thing that I've been working on for a while now, is a layered agent, that we're not exactly individuals, right? But we are actors, and the market is just information. It doesn't want anything. It doesn't want balance. It just is. It's information. Okay, let's go.
Proves why we need a gold standard. Because if we had a gold standard, then we wouldn't have all this money printing, and we wouldn't have all this debasement, regardless of whether 2020 to 2025 was unprecedented or just the normal. We wouldn't have it, and we wouldn't have any of this inflation, and we wouldn't have a loss of purchasing power of the United States dollar. We have to go back onto a gold standard, or maybe even a Bitcoin standard, right? That would put the constraint on money supply growth. Let's put that one to the test. Let's look at this exact same chart from 1960 to 1965. And most of you know that we were still on a quasi gold standard back then. And you can see, represented by this black line, M2 money supply up 50%. So that would be more than we've had from 2020 to 2025. But I know a lot of you out there are saying to yourself, okay, George, fine, but you yourself admitted this is a quasi gold standard. It's nothing like we had in the late 1880s. That's what we need to go back to, because if we had the gold standard, the most strict gold standard we have had as a nation, then this would give us the prosperity. This would limit the money supply growth, and that would lead to the incredible deflation, the good type of deflation that we had in the late 1800s. See, we need a more strict gold standard, not just this flim-flam, this flimsy gold standard we had in the 1960s. Well, let's put that one to the test. Let's go back and look at 1880 to 1885. And there you go. Money supply increased by, call it 70%, high 60s, 70%. So out of all the 5-year periods at the beginning of decades in U.S. history that we have just gone over, the one with the largest debasement of the currency was when we had a gold standard. In fact, the most strict gold standard that we've ever had. Why is that? How can this be possible? Because at the end of the day, the government, the Federal Reserve, doesn't control the money supply. Who does? It's the banking system. It's the banking system. So one of the main points of this video is when you look at this is.
Yeah, I really like that example. That was really well done. I would just say, I just reiterate that M2 is not a good measure. It's not a good measure now. I mean, there might have been a brief period, say in the 70s or 80s, that it was a good measure, but not really. But if you go back in time to the 19th century, it's not a good measure. So it's really bad measure of money. I don't like it. But his point is very well taken. Like I was just saying, during a gold standard, monetary gold increased by 3.5% a year. So what's the difference? Well, the difference might be the risk profile. Like if you're growing at 3% a year, inflation is growing at 3% a year, the economy is growing at 3% a year, Things are there's fewer boom and busts that could lead to gently falling prices. But it has to do with technology as well. And what's, what kind of industrial increases are you seeing? Efficiency increases, productivity increases, that kind of thing. But yeah, the more I've dove into this topic, the more that inflation is a constant, even on a gold standard. And so it has to be constant on a Bitcoin standard too. It has to be. So how will that be? Well, Bitcoin itself won't expand. It will stay at 21 million. But there will be derivatives. I wholeheartedly think that. That's one reason why I think that side chains would be a good solution, because you can have completely different rules in a side chain. So you can have pegged Bitcoin in the side chain, and you can have algorithmic monetary policy that inflates the amount of sidechain coins, dilutes that Bitcoin at a certain rate. You can have different rules, different jurisdictional rules. But if you want to go from sidechain to sidechain, you can do like atomic swaps, stuff like that, for a fixed Bitcoin to Bitcoin exchange rate. But yeah, it's not the debasement trade going on right now. That's why when I was talking about gold earlier, and I was like, Nick Bhatia says he doesn't know what's going on. I really don't know what's going on. It's so extremely overheated. It does not make sense unless somebody blew up. Nick Bhatia was talking about some short squeeze. And now, let's say you're JP Morgan and you're naked short gold, okay? And you're getting squeezed and you're losing billions of dollars. Like the size of the gold market, the market cap of gold has gone up by like $10 trillion in the last few weeks. Or I should say probably last year, we can say it's gone up by $10 trillion. What if you are naked short and you're squeezed and you're JP Morgan or Deutsche Bank or some large player? Let's say you're a Chinese bank. I think that's holy shit. What if that is? What if it is a Chinese bank? Oh my God. That could put a couple dots together on that. What if you're a big bank and you're getting squeezed by this gold? That is then going to ripple down through the banking system. And we could have need for an emergency rate cut. And it might not be, it might happen and no one even notices. Of course, the people that are watching this day to day and worry about this type of stuff, we will notice, but the average person might not even notice. I don't know. Because remember back with the regional bank stuff back in 2023, March 2023, Silicon Valley, Signature, they were squeezed. They got bailed out, and no one really noticed in the broader market, in the broader public. So something could happen like that. It's very interesting. We're still here in October, still here in this window of end of Q3 bottleneck. And we're starting to see some of these things break. Very interesting to me. Gold might be a window onto something breaking. What it is, we'll have to find out. But right now, it's unclear. But yeah, George did a really good job on this one. I appreciate this video. I'm not going to watch the rest of it because it's already 5:30. We're getting close to 5:30. But yeah, that was good. Let's see. Just going to share the website here real quick. Bitcoinandmarkets.com. That's for all my Bitcoin writing. The top post, the top tier is going to be the same on bitcoinandmarkets.com and on the Substack. But the blog posts that I put out and stuff are going to be more macro focused on Rogue Macro and more Bitcoin focused on Bitcoin and markets. So here is Rogue Macro's website. And I'm going to start putting some of my macro stuff over here. Like I did this housing costs, inflation versus lifestyle, the common futures fallacies, some of these things that aren't like Bitcoin centered, they are economics or macro centered. Those are definitely going to go over there on Rogue Macro. So, all right. Let's check the price one more time before we get out of here. Hoping Bitcoin has recovered a little bit more. No, 107.4. Share that tab. We're having a nice long wick. I wonder if we can get up. Like, when does this close? Doesn't this close like at 6 or something? So if we can get up, that would be amazing if this could turn into a green day for Bitcoin. All right. That does it, guys. Let me check the comments here, see if anybody has anything. Guys on the Telegram, I did post that tunnel idea that Putin or somebody over there in Russia was saying, hey, let's get Elon Musk to dig this tunnel on the Bering Strait. Man, I thought that my first reaction was cool. I can drive to Europe now, or I can drive anywhere pretty much. That'd be awesome. I would say like 18-year-olds, they're going to go on some major road trips, dude. This is going to be awesome if this actually gets built. I can't believe no one's even talked about doing this before. I guess it's pretty long. Let's see. How long is it? I don't know. It doesn't say. Give me a break. I'm game for that, man. Let's see what else we got here. Oh, this one. Let's see if I can share this with the other guys with the live stream. All right. And bring that up. Hope this is sharing big. But what this is Bitcoin to gold. Is that right? Yeah, Bitcoin to gold on the bottom here. And when it hits this pink line, which means that Bitcoin's undervalued compared to gold. And every time that it's hit this pink line, it's been at a major bottom in the price, as you can see. So back at the bottom in, what is this, 2015, the 2018 bottom, COVID, then the November 2022 bottom, and today. And why I think this is interesting is because it feels like this. I get a feeling that that common saying, we get repaid for hodling, right? You get the Bitcoin you deserve, and holding is hard. And in a bear market, it doesn't feel good at all. And that's, sorry. And that's what I'm feeling right now. It's not feeling good. Are we even in a bull market yet? This right here is telling us we're not. But I mean, it is a very particular time with gold right now. We don't know exactly what's going on with gold, but I'll tell you what it isn't. Okay. This big moonshot in gold is not China ditching the dollar. I'll tell you that right now. So all this stuff with Luke Groman and all these people that are talking about the dollar's dying, and it's this intricate web of conspiracy and flexing of muscle by the Chinese. It's totally wrong. That's not what's happening. Somebody's blowing up somewhere. Something else is going on in the bowels of the system. And that's what we're seeing with the gold price. So anyway, I thought that was very, very interesting. I hope that came up on the screen share, guys, because now I'm showing that it wasn't. Sorry about that. All right, that's going to do it for today, guys. Thank you for joining me. My name is Ansel Lindner. Check out bitcoinandmarkets.com. Check out roguemacro.substack.com. Follow me on Twitter at Ansel Lindner, and I will see you guys on the next one. Have a great weekend. Make sure you tell people that you love them this weekend. Those are the people in your life that really matter. That's what matters. That's why we do what we do for our jobs, working stiffs every day, in and out. Spend time with those people. And yeah, I hope you guys have a great weekend.